everybody. Welcome to the podcast again. I am honored to have a special guest on the podcast, Chris Whalen, who is the investment banker and writer. He's a chairman of Whalen Global Advisors LLC and focuses on banking, mortgage finance, and fintech sectors. Chris appears regularly on CNBC, Bloomberg, and Fox News. I read Chris's blog, theinstitutionalriskanalyst.com. Watch his interviews on YouTube. Chris was also an advisor of my favorite Showtime series, Billions. Watched every episode, loved it. Huge fan. And it's all about substance with Chris. Whenever Chris talks, everybody listens. Chris, welcome.
Well, thank you, Alex. I appreciate those kind words.
My pleasure. Well, I wanted to start with crypto, believe it or not. Read your recent article, and I actually wanted to talk about your views on crypto. And I guess if I would invest with Bitcoin or into Bitcoin a year ago, I would make 5x of money if I would sell it today. But I don't see how crypto correlates to the money supply. So I wanted to get your opinion on why do you think it correlates? Because to me, if there's no money supply, the crypto should go down. And you are of opposite.
Well, look, there is no direct link between the money supply and crypto. Crypto is simply a function of those who want to play the game. It's a new game. Humans create new games when they can't make money with old games. And I think that and the questions about the dollar, which was the first cryptocurrency, let's remember, are driving people to look for alternatives. I don't see it as a parallel for gold. I don't see it as a store of value. It's just something else we can play with. There's no difference between that and trading, say, the penny stocks of Fannie Mae and Freddie Mac. There's not a lot of value there, but they do move around a lot. And I think it's that momentum aspect, the shiny object, that gets people's attention. Humans are hardwired to chase the shiny object, just like a smallmouth bass. I mean, they're the same.
So basically what you're saying is that there's a bet in the market that the dollar will continue to weaken because of the extra money supply that the new president will bring to the table initially. And I guess the safe haven is gold and crypto. Or you think it's something
that has not been the case yet. Since COVID and really going back to 2008, a lot of the correlations that we think that we know about markets have broken down. So I would tell you that the way the world is working today, whether you look at equities or Bitcoin or many other things, the problem is that the demand for the dollar is not just about the currency. The demand is also about risk-free assets that are used as collateral in transactions. So, for example, when the Chinese want to raise money to invest in an African country, what do? They borrow dollars. They're not going to borrow in yuan because there is no market in yuan. It's a tiny, tiny market. And China, frankly, is a tiny country in financial terms. They present a very large image, and they kind of puff themselves up like an animal that doesn't want to be eaten by a predator. But they're still a tiny country, and they're largely running on cash. There's no natural leverage in China because they don't pay back the loans. Leverage only works if most people pay back the loans. So it's an allocation system more than anything else today. It's the way I think about China. I actually read Chinese history at Villanova with one of the great scholars of the time, Cornelius Kylan. So.
Okay, so coming back to how we look at crypto, do you think the IRS and U.S. government will go after the crypto traders or folks that are making money in crypto?
Yes, and there's a couple of concerns. I'm a banker. I'm a member of FINRA, so I live in the world of a broker-dealer. Anybody who touches coins, the actual coin, becomes a compliance problem. They are immediately flagged for KYC, know your customer, and anti-money laundering. because you don't really know who the counterparty of that coin transaction is. So compliance, the U.S. anti-money laundering, anti-terrorism regime, that's your first problem. The second problem is a more banal one, which is the IRS. The IRS wants your taxes. So they are going to very aggressively be pursuing people that are onshore in the United States who actually touch coins. I've told my clients, if you want to play with an ETF. Play with something that is onshore, that's been blessed by a federal regulatory agency, because at least then you don't have the KYC and the AML problems. So that's it. All of the major industrial countries are going to be focused on crypto when it comes to taxes. You know this, right?
Yeah, of course. I played with crypto myself, and it was an um, honest reporting of the results to IRS based on their questions from last year. What I bought, what I sold. I use Coinbase, so that's pretty transparent.
Yes.
I wonder if folks that use other exchanges in Europe would need to request a different sort of reporting structure so they can report to IRS.
Oh, yeah. Well, that's the thing. A lot of my friends have a foot offshore.
Yeah.
So they trade the coins offshore. They don't report it. And eventually they're going to get caught. The IRS is very, very good at finding you if the numbers are big enough. So, that's kind of the way I look at it. There is no way. I'll give you another example. I have friends who live in Lebanon. Okay. In Lebanon, they use Bitcoin as a currency because they don't have a government. They pay for services, they pay for energy, all with Bitcoin, mostly through physical exchange, by the way. They literally hand people the number. But that's a different use case. These are people who are offshore and, frankly, they need an alternative because their country doesn't have an organized government.
Similar to El Salvador, right? Where they just declared.
Totally. That's right. That's right. So there are many use cases, even offshore in China. China immediately banned Bitcoin because they saw it as a competition to the fiat currency used by the state. If it ever gets popular enough in the U.S., it'll also be banned because no fiat currency can tolerate competition. I'm getting ready to re-release my first book, Inflated, in May of this year, and we compare crypto with the Silverite movement of the 18th and 19th century. Why did people want silver? Because they couldn't make money any other way, so they dug it up out of the ground. The problem is the price kept going down.
Yeah.
And when they forced the government to buy it at the end of the 1800s, it created huge inflation. They would buy silver, give people paper, and then people would immediately exchange the paper for gold. And this is why FDR ultimately banned gold, because he realized that there was no way to reflate the economy if people were going to run out of paper and go back into the only money that's not debt, which is gold.
So now if I would be a President Trump, which I'm not, I would probably go after crypto to strengthen the dollar. But he's not going after crypto.
They should, but they're not going to do that. They should.
Yeah, I mean, he wanted to bring the crypto crowd as the voters. He promised them low energy to go and mine cryptocurrency. So that's a dilemma right now, right? So if you want to strengthen the dollar, that's the very first thing that you would go after.
We'll get there. We're not quite there yet, but let's assume eventually your thesis is correct. People look at the fundamentals and they've run out of dollars. That's going to eventually come. But for now, people need both the currency and also the assets, the treasury paper, to conduct business. Financing. How do you finance oil, for example, in other currencies? You almost can't because it's too big.
So one thing I wanted to touch on, who is the greater fool in the crypto scheme, right? Who loses the money? I mean, you see this uptick in the cryptocurrency, in the Bitcoin, 5x, 6x uptick.
Yes.
Where are the losses? Who loses the money? Is that the non-institutional?
The last buyer.
Okay.
It's a greater fool system. Now, I was just contradicted by Larry White on X this morning, who said people are willing to buy it, therefore they are creating wealth. Okay, I'm creating wealth for the buyer who is astute enough to sell it at the right time. The same way I'm creating wealth for the guy who buys Fannie Mae at $1 and then it goes to $4.
Right.
Okay. But really the beneficiary here is government because we're creating taxable income where, frankly, none existed before. And they love it. This is great stuff for them.
Understood. So really, investor be aware of the crypto schemes because it on the paper it looks great. It always goes up, right?
Well, just don't pretend it's an investment. As long as you keep in your mind straight that this is a trade and this is a short-term speculation, then fine. These are all consenting adults. I call crypto party poker on LSD. That's where many of my friends who trade crypto came from. They were commodity traders, they were foreign exchange traders, and God bless them.
Yeah,
I have some friends who've, created millions of dollars in personal wealth. Okay, I get it. But then look at all the frauds.
yeah. I call it funny money. If you're happy to lose that funny money, good luck.
Yeah, that's right. But the IRS isn't going to take coin for tax payments. They want dollars.
True. Agreed. So that's a good segue to consumer behavior, right? So everybody wants to be a millionaire. Everybody wants to invest in crypto and get 5x returns. While we look at the average consumer and the delinquency rate is on the right for credit cards. I was really worried last year that, the credit card delinquencies are going too high, too fast. And I think I read your article about net charge-offs still remaining low, but is it political or actual, right? You have some political momentum to stop the foreclosures, stop the delinquencies, offer all kinds of loss-made options, hold the delinquent borrower in their homes. It was more political than the, letting the system work out all the delinquencies on its own. How do you approach that? And what do you see today on the charge-offs and consumer behavior front?
Well, look, there's 500,000 people right now who are still getting some sort of forbearance on their mortgage. That's come down a lot. The top was about 8 million. And the way I look at it is the period of quantitative easing and COVID suppressed visible default rates. So the cost of credit fell, even though obligors were still getting kicked around pretty badly, especially low-income consumers. But from a portfolio perspective, if you're the shareholder of a bank and you're looking at the losses on their mortgage book or their credit card book or auto loans, all of them were depressed dramatically by what happened in the marketplace as a result of the Fed. So now we're kind of normal now. Yes, the rate of loss given default on credit cards is going up. The trouble is the dollar flow of losses in that portfolio, which has grown 3 times since 2008, by the way, it's over $1 trillion, is pretty de minimis. It's not a problem yet. So until we start to see the volume of loss get way up in the double-digit billions, that's going to be when it becomes a matter of concern for banks and earnings and that sort of thing. I fully accept that when you look at that FHA delinquency number at 11%, it's probably 3 to 4 points understated. My guess is the real rate of delinquency is in the mid-teens for FHA because that bottom quartile of consumers, the people who are being forced to sell their homes because they can't afford to live in the house anymore, even with a low-rate mortgage, by the way. If you look at the number of mods that people in the industry are doing over and over again in order to hide the delinquency, sure, there's a problem there. Now, it's interesting, FHA is discussing ending partial claims. They're talking about only allowing lenders to do one partial claim every 18 months. What do you think is going to happen if they do that?
One shot
that visible delinquency rate will go up.
Exactly.
Yeah.
But do you analyze the losses within the subsectors of the mortgage industry? And do you see that Ginnie Mae is the leader of the pack, where most of the borrowers there really delinquent, and Fannie and Freddie really have a clean book?
Yes. I mean, I'll give you think about the mortgage market this way. The bottom is FHA and Ginnie Mae. The middle is conventionals. It's really half of the total. And then the top is jumbo and private label, bank loans, right? It's about a quarter. The conventionals look just like the bank loans. Now, as you go down in terms of size, below that average $400,000 size, the delinquency gets worse, clearly, because these are smaller homes, smaller income levels for the borrowers. But when you look at that top half of conventionals, it looks just like bank loans. And right now, the banks are negative. Loss given default on 1 to 4 is owned by banks is still negative by almost 100%. What does that mean? It means that when there is a default occasionally, right, they get the full proceeds of the loan back and then they make money if they actually own the note. That's crazy. So that shows you the skew that was caused by the Fed's actions and by home prices. As long as home prices stay where they are, or even, deteriorate a little bit, credit is still going to look like it's free. We haven't seen this since 2006, 2005. So eventually this will end. Stan Middleman, I did a bio of him that came out in September. He predicts 2028. He says misery on the eights. That's when we have a macro home price correction. And, in our discussions, he's basically said, I think it'll go back down to 2020 or 21 levels. But there's a lot of uncertainty here because there's still so much liquidity in the system. And as you know, there's no homes. If you go down below that average $400,000 mortgage, the competition for assets is intense. So when are home prices going to go down? Good question. It may not. So we have this artificial factor that's making credit look better than it is, even though the obligors are under a lot of pressure. It's a very strange situation.
It's interesting. Boy, you just said a lot of things to think about there. So you're predicting or Stan predicts in 2028, you will see the same thing as 2008, right?
Well, what he said was eventually we're going to get lower rates from the Fed. Sure. Maybe we'll see some relief on the long end, not this morning. Fannie sixes for the end of the month are trading at par. Yeah. So, everybody is selling sevenths into that contract. I don't know if it's going to come down anytime soon. For exactly the reasons you stated. Imagine if the dollar weakens. Imagine if people start worrying about Trump and the deficit. What's going to happen to mortgage rates? The Fed kind of created this impression in the industry that it was normal to have spreads below 1%. But that's when they were buying mortgage securities. Yeah. If they're not buying, and if the banks are still kind of neutral in terms of their purchases, where are we going to get spread compression? That's really the issue.
Yeah. So again, it's during the Trump presidency, the mortgage market has to heal and recover, right? It has to go through the recession. I think we both agree that there will be a point where we will feel that we're in a recession. There will be a lot of job losses. There will be a lot of delinquencies, right? We expected that. I expected that in 2023. We didn't get there.
Yes. Well, everybody got faked out. We were talking about a recession last summer.
Yeah, exactly.
Never happened. And now I'll tell you honestly, I think that really what we're dealing with here is a sea change where the current rate structure, the current term structure of rates is normal. This is where we're going to be. We're not going to go back to where we were in 2021. And you see this in the industry because the industry is consolidating. If you have less than $200 billion in servicing assets, you're too small. Think about that. There are a lot of companies that can get forced out of this industry, especially if volumes stay where they are. And all of these companies turn into asset managers who are sitting on their MSRs. Because that's really you make a little on a loan today, not very much, but you make the money on the MSR. That's where the trade
and you
is.
Already see
and that's why people like Stan Middleman and Rocket and the rest of them are out paying, very significant premiums to buy MSR.
And the Flexstar transfer to Mr. Cooper, creating Mr. Cooper as the largest one. It's all.
Yeah. It was, Flagstar was kind of marginal in a sense. I think they would have stayed in if they hadn't, merged with New York Community Bank, which was a fiasco. But now we don't have any significant bank presence in government mortgages. That's not good. There are a few banks that are pretending to come in, but I don't think they have an appetite for Ginnie Mae. Ginnie Mae is a business that really has to be managed by issuers. When I see investors starting to get interested in Ginnie Mae, that scares me.
And there's plenty of those. I can tell you that.
Mostly they do
Yeah.
conventionals. I mean, look at Bill Greenberg at Two Harbors. He's 100% conventionals. And that's a safe bet because those issuers get taken out after the fourth month. They don't have the financing load that a Ginnie Mae issuer has.
Well, let's switch topic a bit to Fannie and Freddie exit, right? This is a hot topic. Everybody talks about it.
Mm,
I personally invested in Fannie Freddie when Aikman did, and then I got really disappointed. And then I exited. I sold what I had, suffered a bit of a losses, and now all of a sudden
mm.
the stocks for Fannie and Freddie on the rumor news is up, what, 70%? So
Oh, yeah, they were both up hundreds of percent the
do
last
you
12
think
months.
it's Aikman and similar investors are, you know, putting a news that it's still possible within Trump presidency, or you don't believe that it's feasible?
Oh, no, it's feasible, but be careful what you wish for. I think all of the funds, Ackman, the rest of them, are playing the short term trade.
Yeah,
So they make public statements. The stock goes up, they make money. The stock goes down, they make money. So it's a classic pump and dump.
yeah.
I personally think that it's inappropriate to recommend either one of those stocks as an investment for retail because we still don't know. What a lot of people don't realize is that if Fannie and Freddie come out of conservatorship, all of the credit support that Moody's and the other agencies have depended on is going to go away. So that's the real issue, I think. People don't understand what release truly implies. Well, go back to the point.
Yeah.
If you release Fannie and Freddie and you work at Moody's, before they're released, you're going to have to decide what the rating is going to be once they're not controlled by the government. I'm thinking a full rating category lower than they are now. So they're AAA from Moody's.
Yeah.
Think of it as a double A, maybe a single A plus. Think about where their debt goes in that event. How much are their spreads going to widen? And then your friends at Freddie Mac, right? Can they make up what they're going to lose in terms of higher funding costs, either by increasing their own fees or by efficiencies inside their enterprise, maybe cutting back on some of the free stuff they give their correspondents? So that's, to me, the challenge for both of these enterprises. What is the business model going to look like a year after I'm released? Am I still going to be in multifamily? Maybe not. The Republicans may restrict that. The Republicans may take them out of second homes. They may take them out of second liens, which they make a lot of money on. So all of these profitable areas that the banks would like to have to themselves, remember, there's politics there.
Yeah.
That, to me, is the discussion we still haven't had.
So really, they have to find a way where they don't charge the extra bips to the originators to go and securitize the loans, because the originators all of a sudden have an option to go and securitize with the private banks and don't
That's
pay
right.
that amount of money.
Well, initially I thought that the GSEs could cut a new amendment with Treasury and pay them to wrap their mortgage-backed securities. So they would be private issuers, they would own the loans, technically they own the servicing too, but they might have to pay Treasury 15 or 20 bips a year on $8 trillion in assets, right? In the event, I would have said, retain the MSR, just keep it. And you can explicitly pay everybody as a subservicer, you take very good care of them, right? But they would no longer own the asset, you would. They can't do that. Treasury's not allowed to cut a deal like that. And I think as a result, it means that Fannie and Freddie come out, they will have their issuer rating, their unsecured rating downgraded, and then all the securities will be essentially referring to that unsecured rating. I think the markets are going to be very upset by this. And I also think that the NBA, the American Bankers Association, all of the trades ultimately are going to be forced to oppose this. Simply because it's going to be so disruptive to the conventional market, which you and I both know people barely make money when they sell loans into the conventional market. The MSR is where they make money. So if we see structural changes like this, it's going to be a big deal.
Thanks, Chris. That's a wonderful point. I wanted to switch gears a little bit. I know we're both busy, and we have time for one last question. if you have a crystal ball, what would you do in 2025 to make money, right? You have a few headwinds and tailwinds. So you have treasury rates are keeping flats. How would that translate to the mortgage rates? You have the new president coming to the office. I'm sure there will be a lot of executive actions on the day one with a lot of new expenses um, causing some inflation. At the same time, you have DOGE, which will translate to some of the savings. And if you were the investor, or if you would be recommending to the investor, where would you invest money in 2025?
Well, Trump ultimately has to prove to people that he's going to do something about the deficit. Biden wouldn't even discuss it, neither would Janet Yellen. And the only way he can get some traction and buy some time to actually do things he wants to do is to prove to people that he's going to get those numbers to come down. If he does, the dollar will soar. I hate to say it, but it will. They will see at least some evidence that the U.S. wants to keep its franchise. But if not, then I think you could see a significant sell-off in the dollar, and that's not going to help mortgage rates. Definitely not. What I've told my clients is I said plan for higher rates. And most of them have figured out how to survive at these levels with 90% purchase volume. But I don't know how long that's going to last. Well, the REITs, you have to pick and choose. I would stay away from commercial. Even the resi REITs with the high yields, they haven't done that well. Look at Annaly, which I used to own years ago. The only ones I really like are the big issuers that have large MSR books, so Cooper, PennyMac. These performers have done actually quite well. Two Harbors is interesting. He's trying to build his own servicing business. But a lot of the interesting ones are private. You can buy their debt, but you can't buy Bayview, unfortunately. You can't buy Freedom, is one of the better, private issuers, long-time client of mine. And I think that, if you're interested in the sector, you're almost locked out as an individual investor. You could buy the stock, you could buy the preferred, but you can't own the MSR. And that's really the game for a lot of these companies. So I like the model that I see over at Bayview. These guys are really smart. They took the team from MetLife when they got out of the mortgage business. Now they cater to the insurance industry. They help insurance companies buy mortgage assets. That's a very, very good business. And there are others trying to emulate that model. It's a private model. This is really not for public investors.
Yeah, I agree. I think Trump presidency will bring a lot of the fun and exciting changes to the governments, to the mortgage industry, and to the investment into United States. So I'm sure that when we talk, there will be a lot of exciting news to talk about.
We'll talk after the inauguration. You'll notice that Trump has been very disciplined this time. No leaks, no public fussing. His campaign manager is now the chief of staff. She's really good. She's extremely disciplined. So I think, watch what happens. I think Trump has an opportunity to do some good. But, the truth of the matter is most people in Congress don't want to talk about taxes. They don't want to talk about cutting its spending. The process is pretty dysfunctional. So we'll cross our fingers. But yeah, we'll definitely do something later in the year.
Chris, tell us where to buy your book. I think your book is coming out, where people can watch you, follow you, read about you. Let us know, and I'm sure my audience will subscribe and follow everywhere you make your opinions or write in articles and blogs.
Yeah, my pleasure. Let me tell you how people can find me. I publish The Institutional Risk Analyst. I'm active on X under RC Whalen and on LinkedIn as well. And the new book, Inflated, is coming out in May. So we have a placeholder up on Amazon if you want to pre-order it.
Chris, I wanted to thank you for being a part of this podcast. I always listen to you on the X, on the YouTube, your wealth of knowledge. I wanted to thank you from every listener of this podcast for you to coming on and sharing with us your opinion and your views. I'm hoping that you can jump into the podcast towards the middle or end of this year, just to review what happened, whether our predictions were accurate. And again, thank you for your valuable time and looking forward to talking to you on the next podcast.
Thank you, sir.
Thanks for watching the podcast. Take care. Goodbye.